Hi. Let's learn how implied volatility, 4, works with options and examples. Implied volatility is a metric that captures the market's view of the likelihood of future changes in a given security's price. It's used by investors to project future moves and supply and demand. It's not the same as historical volatility, which measures past market changes and their actual results. Implied volatility forecasts a likely movement in a security's price. It's represented by the symbol sigma and is used to estimate future fluctuations based on certain predictive factors. It usually increases in bearish markets and decreases in bullish markets. Implied volatility is a deciding factor in the pricing of options. Options with high implied volatility have higher premiums and vice versa. However, it's important to remember that implied volatility is not a guarantee of future price movements. Implied volatility can be determined using option pricing models. The Black-Scholes model and the binomial model are two widely used models, but they have their limitations, especially in the case of American options. Supply and demand, as well as the time value of the option, are major factors affecting implied volatility. Additionally, implied volatility is subject to unpredictable changes and can be influenced by factors like adverse news or events. Implied volatility helps to quantify market sentiment and estimate potential price movements. However, it's solely based on prices rather than fundamentals, and it doesn't indicate the direction of price movement. Traders and investors use tools like the CBOE Volatility Index to analyze implied volatility and gauge the stock market's volatility as a whole. This helps them form trading strategies accordingly. Implied volatility is important for options pricing models because the future volatility is one of the inputs needed for these models. It helps investors estimate future volatility levels. Implied volatility is computed by rearranging an options pricing model formula to solve for volatility instead of the price. Regardless of whether an option is a call or put, its price will increase as implied volatility increases. A higher implied volatility results in higher option premiums. No, not necessarily. Downside put options tend to have more implied volatility than upside calls due to market demand and other factors. Here are 5 key takeaways. 1. Implied volatility is the market's forecast of a likely movement in a security's price. 2. For is often used to price options contracts, where high implied volatility results in options with higher premiums and vice versa. 3. Supply and demand and time value are major determining factors for calculating implied volatility. 4. Implied volatility usually increases in bearish markets and decreases when the market is bullish. 5. Although 4 helps quantify market sentiment and uncertainty, it is based solely on prices rather than fundamentals. Hope this would help. Thanks for watching.